Hello, we are meeting today to talk about the Chapter 24 problem. This is going to be a very brief, hopefully, tutorial. I'm going to go through each part of the problem and give you some explanation of how to find the answers or how to find the solution. So keep in mind that this problem may be generated algorithmically. So the numbers you see in what I'm explaining may be a little bit different than what you see in your own problem. But the processes we follow to find those numbers are going to be the same. So we're talking about a company and VOR CPAs, and they have a staff that operate in a couple different divisions. The audit division and tax division are their two profit centers. And so they have some costs that are administrative overhead that are allocated, and specifically the one that we're looking at the beginning of the problem is the payroll office. So the payroll office, let's see here. I was trying to skip, but the payroll office issues paychecks. The total expense for the payroll office is $31,500. And we're going to allocate that expense out to both the audit and the tax division as our profit centers. So the total number of paychecks that are issued, right there, we have 110 for the audit division and 340 for the for the tax division. So that's a total of 450 paychecks. And we're going to share or allocate that $31,500 in total expense to the two profit centers based on the number of paychecks they get. So doing the math quickly, we have $70 per paycheck will be the support department allocation. So the audit department, with their 110 paychecks, would receive a total of $7,700 of that $31,500 total expense. And for the tax division, which has 340 paychecks at $7 each, that would be a total of $23,800. So it's not to say that nobody else in the company gets a paycheck. In other words, the payroll office certainly has people working there and they get paychecks, but we're doing support department allocation directly to the profit centers, to the production departments, the way we've talked about them in other problems or in earlier chapters. So now as we're looking to evaluate performance, we know if these are profit centers that we're not going to hold them responsible for how our assets are allocated because they don't have responsibility for those as a profit center. Now it does say right here that the company as a whole may be considered an investment center, in which case we would look at how they're using those assets to generate income and to generate revenues. So I will let you answer those based on the information given there, but let's follow down to the transfer, to the question of transfer pricing. So remember, there is a page in Blackboard in the Chapter 24 reference materials folder that also gives you some hints about how to do this piece. But the first income statement we have here, broken out by division, by the two profit centers. The only thing we need to add here is the support department allocations for payroll that we calculated in the first part. So $7,700 for audit and $23,800 for the tax division. And that is the total of $31,500. We are going to use negatives because these are expenses and reduce our operating income. So from there, you should be able to find those totals, take the operating department before support and subtract those. And as long as we're talking about that, we can come down and do that same thing for each one of the transfer pricing options as well. We're just going to bring those in. And again, to not waste your time on this video, you can go ahead and do those on your own. using negatives because they're going to be subtracted, because those are additional expenses. The rest of the problem looks at the three different versions, if you will, of transfer pricing. So the situation we're told is that the audit division needs more work, and the tax division has some excess capacity of in this example, 800 hours. Again, your numbers may be a little bit different than that. So with those 800 excess hours, basically the tax division is going to sell that to the audit division, and the audit division then won't need to buy them contract labor from an outside source. So once they make that decision that yes, the tax division is going to sell their excess capacity to the audit division, the question becomes one of, well, how much are we going to charge? And that's the difference between these three options. The first option is that we're going to charge them market price. And so if the audit division had to pay an outside supplier for that labor, they would pay $110 per hour. And I am positive that that's one of the numbers that is different in the algorithmically generated problem. So although mine says $110 per hour, yours may not. So if the tax division is selling the 800 hours of labor at $110 per hour, 800 hours at $110 per hour gives them an additional revenue of $88,000. And that's how much they're going to charge the audit division. So that becomes the cost for the audit division, $88,000. And so you can see the offset here, it becomes revenue for the tax division, but an expense for the audit division. Now, in the original income statements here, we showed the excess capacity in the tax division. In other words, we were still paying those workers in the tax division because you can see that they are salaried, so they get paid the same amount, but we didn't have a sale for that. We didn't have a use for that labor, so we had to pay them, but there was no associated revenue. That's what makes it excess capacity. Under these next three scenarios, there is no longer an excess capacity because we're selling it to the other division. So we really don't need that line here, but it's in here just to make it clear to us that there was excess capacity, but there is no longer. So we can enter zeros because it tells us if there is no amount or if it's zero, enter zero. They don't want you to just leave it blank in this circumstance. So how much is that actually costing the tax division? We can see right here, the cost is $48,000. And so no, it's no longer excess capacity. It is now a cost associated with providing that service to the other division, selling those services to the other division. So totaling those, we have a total of $136,000 in expense there. So again, I assume that you can find these totals. Remember, you're starting with revenues up here at the top, then subtracting the expenses to get the operating income before payroll, and then subtracting the payroll to get that bottom line. The next scenario is the negotiated transfer price. And so in this case, rather than charging the $110 per hour that they'd have to charge pay someone outside the company, the two divisions agree to pay $90 per hour. Still 800 hours of labor that they are selling them. And so the tax division has $72,000 in additional revenue, and the audit division has $72,000 in expense. And whatever those two add up to be, and we still have zeros in the excess capacity. So again, I assume that you can take it from here. You have the revenues, you're going to subtract the expenses to get the operating income, include the support department allocation for payroll, and then find your bottom line. And then the last scenario is the other end of the spectrum. So we have market price, and the other end of the spectrum is we charge them exactly how much it costs us. And so we already know this number, but it's $60 per hour for the 800 hours, or a total of $48,000. Again, we already knew that was the value of that labor that was excess capacity, but now it's being transferred to that other division. And so now there's an exact match between what it costs the tax division to provide it and what they're receiving as revenues. What you'll notice then is when you compare the three, is that the company is better off when they can do anything that is a lesser cost than the $110 per hour they'd have to pay someone outside the company. Then it just becomes a question of how do we split that additional profit or additional income for the company? Does it go to the tax division? Does it get split? Or does it simply save money for the audit division? The final piece then is, remember you answered a question up at the top, then the drop-down multiple choice questions about whether they would use the DuPont formula. And that's really what you're looking at here. So now that you have the operating income for each one of the scenarios, you can go ahead and calculate these. And we have the formulas for those. They're in the textbook. We went over them in class, but profit margin is operating income divided by revenues. And investment turnover is how good are they using the assets they have to generate sales. So we have, again, our sales revenue. Somewhere it must tell us what their assets are. I'll be up here and all that information I skipped through. Yep, so right here we have the assets for the audit and for the tax division up here at the top. And so you'd be able to then calculate the investment turnover. You're going to do these calculations separately for the audit division, for the tax division, and then for the company as a whole. Now remember, we did say at the outset, it might not be appropriate to look at the audit division and tax division taking into account their investment turnover, bringing in the question of assets, because if they're a profit center, they don't have control over those assets. That being said, we're just doing this for comparison purposes. And so you can see what the impact is of the three different choices, or I guess four: no transfer, and then the three different choices for what the transfer price would be, and then answer the question related to if the company is an investment center, which one of the four options would be better. And you'll be able to see that very clearly, which gives the best return on investment for the company as a whole. So it's really not how does it look for the audit or the tax division, but the company as a whole that's in question. And so that is the end of the exercise. If after watching this video you still have questions, you need help with anything else, please don't hesitate to ask.